10.7%. That is the average annual return of the S&P 500 over the last 30 years. Financial advisors print that number on brochures. Retirement calculators use it as a baseline. Your coworker who just opened a Roth IRA mentions it at lunch like he discovered fire. And on paper, it sounds respectable. But here's the part nobody puts on the brochure. After inflation, that 10.7% drops to about 7%. After taxes on capital gains, closer to 5%. After the emotional cost of watching your portfolio collapse 38% in 2008 or 34% in March 2020, and somehow convincing yourself to do nothing, the actual return for most investors is even lower. Because most people do not hold. They panic, they sell at the bottom, they buy back in near the top. And they repeat that cycle for 30 years, wondering why their account never seems to grow the way the brochures promised. Dalbar, the financial research firm, has been tracking this for decades. Their studies consistently show that the average equity investor earns roughly 3.5% to 4.5% per year, not 10.7%, because of behavioral mistakes. Meanwhile, a woman in Tampa who owns 3 laundromats and a pressure washing route has been clearing $19,000 a month for 6 years straight. She's never checked a stock ticker in her life. She's never lost sleep over an earnings report. And her income does not care what the Federal Reserve decides to do next Wednesday. After studying hundreds of business models, financial reports, and real operator stories, I found 21 businesses that consistently outperform the stock market on the metric that actually matters: cash flow you can control. Not paper gains that disappear in a correction, not unrealized returns that require you to sell at exactly the right moment. Money that hits your bank account every single month, whether Wall Street is up, down, or sideways. Some of these are going to surprise you because they sound too simple. Others will make you uncomfortable because they are too boring to brag about. And if you only remember one, make it the last one on this list. It has quietly built more personal wealth than most hedge funds ever will, and almost nobody talks about it because there's nothing impressive to say about it at a dinner party. My name is John. Let's get into it. Business 21, pressure washing. I am starting here because this is the lowest barrier to entry on the entire list, and the comparison to the stock market is almost embarrassing. A commercial-grade pressure washer costs between $2,500 and $4,000. Add a surface cleaner, hoses, and a chemical kit, and your total startup runs about $3,200 to $5,000. That is it. A single residential driveway and house exterior job pays $300 to $500 and takes about 2 hours. If you work Saturdays only, doing 3 jobs per day, that is $900 to $4,500 per week from 1 day of work. Annualize that. Even at the conservative end, $4,600 to $800 a year from a $4,000 investment. Run those numbers as a return on invested capital, and you are looking at over 100%. The S&P 500 gave you 10.7%. Let me put that in perspective. You would need to invest $437,000 into an index fund, returning 10.7% to generate the same $46,800 annually that a $4,000 pressure washer produces. Now, this is not passive. You are physically doing the work. But here's the filter I want you to carry through this entire list. The stock market gives you returns you cannot control on a timeline you cannot predict. These businesses give you returns you directly influence with effort you choose to apply. That is a fundamentally different relationship with money. And it is one the financial industry never wants you to think about because they earn fees when you invest, and they earn nothing when you buy a pressure washer. Business 20, mobile car detailing. A full interior and exterior detail charges between $150 and $300 per vehicle. Product cost per car runs about $15 to $20. That is a profit margin of 60% to 80% for a solo operator working out of a van or a garage. The startup cost is a buffer, a vacuum, ceramic coating supplies, microfiber towels, and a canopy tent. Total about $2,700. Do 3 cars on Saturday and 3 on Sunday at an average of $175 each. That is $1,050 per weekend. 4 weekends a month, $40,200. Annualized over $50,000 from a $2,700 investment. A Reddit commenter in the detailing subreddit put it perfectly. Nobody dreams about detailing cars. That is exactly why it pays. The dreamers are all fighting over the same 10 oversaturated online markets, while detailers are buffing Hondas for $200 a pop, with almost zero competition in most zip codes. And here is what most people miss about car detailing. It builds recurring revenue naturally. Once someone sees their car looking showroom new, they come back every month. They refer their neighbors. They add ceramic coating packages at $500 to $800 a pop. One detailer in Austin documented on the Sweaty Startup subreddit that he went from $0 to $7,200 a month in 5 months by doing nothing except quality work and letting word of mouth do the rest. No ads, no website, just results. Business 19, vending machines. Here's where the math starts getting interesting, because now we are talking about a business that earns money without you being physically present. A basic vending machine costs between $500 and $6,000. You stock it with snacks, drinks, or specialty items like protein bars and phone chargers. Place it in a factory with 200 employees, a gym lobby, a car dealership waiting area, or a community college hallway. Revenue runs between $300 and $600 per machine per month in profit after product costs. Time investment, 1 to 2 hours per week restocking and collecting. Let's do the simple math. 5 machines in solid locations, $400 average monthly profit each. That is $2,000 per month, $24,000 per year. If you paid $4,000 per machine, your total investment is $20,000. Your annual return, 120%. Now compare that to $20,000 in the stock market at 10.7%. That gives you $2,140 in year one. The vending machines give you $24,000, 11 times more. And the vending industry is projected to hit $25 billion by 2027, with a 95% business survival rate over 5 years. Compare that to the stock market, where the average investor holds a stock for less than 5.5 months, and 90% of day traders lose money. Here is the first pattern you're going to see repeating across this list. Boring machines and boring locations beating sophisticated Wall Street returns by multiples. Not by fractions, by multiples. Business 18, lawn care and landscaping. Grass does not stop growing because the stock market had a bad quarter. It does not pause in July because a hedge fund blew up. Every residential lawn in the Sun Belt needs mowing every single week from March through November, and every commercial property needs it year-round. The lawn care and landscaping industry in the United States generates over $130 billion in annual revenue, according to IBIS World. A solo operator with a commercial mower, a trimmer, a blower, and a trailer starts for $5,000 to $12,000. A residential mowing route of 30 homes at $40 per cut, serviced weekly, generates $200 per week. That is $4,800 per month, roughly $52,000 per year during growing season from an $8,000 startup. Run those numbers against an $8,000 investment in the stock market at 10.7%, and you get $856 in year one. The lawn care operator earns $52,000 from the same capital, 60 times more. And here's the part that turns this from a job into a recurring revenue machine. Once you sign a homeowner onto a weekly service agreement, they almost never leave. The switching cost is not financial, it is emotional. People do not want to find a new lawn guy. They do not want to explain where the flower beds are again. They do not want to risk a stranger near their property. That inertia is your retention engine. Add seasonal upsells like leaf removal in fall, aeration in spring, and holiday lighting in December. And a single residential client can generate $2,500 to stack 50 clients, and you have $125,000 to $200,000 annual business that the S&P 500 could never replicate from an $8,000 starting investment. Business 17, ATM ownership. Most people do not even realize you can own an ATM privately. It is not a bank product. It is a consumer product you can buy online for between $2,000 and $4,000. You place it in a high-traffic location, a bar, a convenience store, a barbershop, a small hotel. You negotiate a placement deal with the location owner. Every time someone withdraws cash, you collect a transaction fee of $2.50 to $3.50 per withdrawal. An average machine in a decent location handles about 200 to 400 transactions per month. At the midpoint, 300 transactions at $3 each, that is $900 per month from a $3,000 machine. Annualized, $10,800 on a $3,000 investment. That is a 360% annual return. And it requires 30 minutes a week to restock the cash and check receipts. A financial advisor would need to put you into extremely aggressive, high-risk investments to even approach half of that return. And you would still have zero control over the outcome. With an ATM, the return is determined by foot traffic, not by market sentiment or central bank policy. Now, cash usage has declined with digital payments. That is true, but here is what nobody tells you. In nightlife districts, cash-heavy small businesses, and underbanked neighborhoods, ATMs still process heavy volume. The operators who thrive in 2026 are the ones who place machines where cash is not optional, it is preferred. Bars where tips are in cash, barbershops that run cash only, flea markets, laundromats. Those locations have not changed. Business 16 coin-operated laundromats. The laundromat industry in the United States generates approximately $6.8 billion in annual revenue. But here's the number that truly matters. The 5-year survival rate for laundromats is approximately 95%. That is not just a survival rate, that is a dominance rate. Compare that to restaurants at 20%. Compare that to tech startups at 10%. Compare that to the stock market, where approximately 40% of all S&P 500 companies that existed in 2009 no longer exist today. A laundromat generates average annual revenue of $150,000 per location, with net profit margins of 20% to 35%. The purchase price for an existing laundromat runs $200,000 to $500,000. At the midpoint, a $350,000 investment generating $40,000 in annual net profit is an 11.4% cash-on-cash return. That already matches the stock market's long-term average. But here is where the laundromat beats the market completely. That $40,000 is real cash depositing into your account every single month. Not a paper gain that disappears in a correction. Not an unrealized return that requires you to sell at the perfect moment. Cash. And the asset itself, the laundromat, appreciates in value while paying you. The stock market gives you dividends or capital gains in any given year. A laundromat gives you both simultaneously, with 95% certainty that you will still be operating 5 years from now. Modern laundromats run on card payment systems, remote monitoring apps, and automated alerts for machine failures. Some owners manage multiple locations from their phone. 4 to 15 hours of actual owner involvement per week. The machines do not care whether the market is open or closed. They spin, they earn, they repeat. Business 15, Pest Control Routes. There is a reason Rollins, the parent company of Orkin, has increased revenue for over 20 consecutive years. Through recessions, pandemics, and market crashes, Rollins just kept growing. Cockroaches do not check the stock market before they breed. Termites do not pause their consumption of wooden structures because the NASDAQ dipped 12%. And bedbugs do not care whether your 401k is up or down. The U.S. pest control industry generates approximately $25 billion in annual revenue, and has grown every single year for the past 2 decades. One road of 82 homes, each paying $59 a month for basic pest control, generates $4,138 in gross monthly revenue from one technician, one truck, and chemicals. Startup cost, $10,000 to $30,000. Annual revenue from a single route, over $58,000. Add 2 more routes, and you have a multi-6-figure business that is more predictable than any blue-chip dividend stock. And 80% of pest control revenue comes from recurring quarterly service agreements. 1 signature equals 4 visits per year. Stack 100 contracts at $100 per visit, and you have $40,000 in guaranteed annual revenue from customers who biologically cannot cancel. The stock market has never once guaranteed you $40,000 in anything. Business 14, commercial cleaning contracts, not residential house cleaning, not scrubbing someone's bathroom on the weekends. I'm talking about commercial contracts for offices, medical facilities, and retail spaces. A single office cleaning contract for a mid-sized building pays $2,000 to $5,000 per month. The startup cost is cleaning supplies, a vacuum, insurance, and a business license. Total, $5,000 to $15,000. The commercial cleaning industry in the United States generates over $90 billion annually. And here's the part that transforms this from a job into a wealth machine. Commercial clients sign annual contracts. Those contracts renew automatically because the building manager does not want to think about who is cleaning the building. They want it done. They want it done consistently. And they want someone else to handle it, so they never get a complaint from a tenant. Once you hold that contract, you are functionally invisible. And invisible, in commercial cleaning, means indispensable. A solo operator with 5 commercial contracts at $3,000 each generates $15,000 per month, $180,000 per year, from a $10,000 startup. That is an 1 to 800% return in year 1. The S&P 500 has delivered that return exactly 0 times in its entire 98-year history. Now, I know what you're thinking. That requires work. That requires hiring people. That requires showing up. Yes, it does. But so does monitoring a stock portfolio, rebalancing quarterly, researching companies, and managing your own emotions during a crash. The difference is that the cleaning contract pays you $15,000 a month for your effort. The portfolio management pays you anxiety. Business 13, self-storage facilities. The U.S. self-storage industry is valued at over $45 billion. There are more than 50,000 facilities in the country. Nearly 1 in 8 American households rents a storage unit. And the average tenant keeps their unit for over 14 months. That is 14 months of automatic recurring revenue from one customer who signed up once. Here is what makes self-storage better than the stock market on almost every measurable metric. Occupancy rates nationally sit above 90%. Revenue is recurring, automatic, and charged to a credit card without you sending a single invoice. Late fees add 10% to 20% to the monthly bill during economic downturns when tenants stretch payments. And if a tenant abandons a unit entirely, you auction the contents and keep the proceeds. The business literally monetizes every possible scenario. Good economy, people accumulate stuff and need storage. Bad economy, people downsize homes and need storage. There is no market condition in which people suddenly stop owning things. The startup cost is significant, $500,000 or more for a small facility. But the cash-on-cash returns of 8% to 15% combined with asset appreciation of 5% to 8% annually means total returns of 13% to 23% per year, consistently, year after year. That beats the stock market average every single year, and you own a physical asset that you can see, touch, and control. You cannot touch a stock. You cannot improve a stock's performance by upgrading its payment system or adding climate-controlled units. A storage facility responds to your decisions. A stock responds to a CEO you have never met making choices you will never understand. Now let me pause here and give you the filter that separates everything above from everything below. The first 9 businesses on this list beat the stock market primarily on raw return percentage. The next 12 beat it on something even more valuable: predictability, control, and compounding cash flow that you can reinvest on your own terms. Morgan Housel wrote something in The Psychology of Money that I think about constantly. He said the highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today. That is what wealth actually is. Not a number on a brokerage statement. The freedom to control your own time. The stock market does not give you that. It gives you anxiety, push notifications, and the illusion of control, while 1,000 variables you will never understand determine whether your money grows or shrinks on any given day. The businesses on the rest of this list give you actual control. And control, it turns out, compounds faster than any index fund. Business 12, HVAC services, heating, ventilation, and air conditioning. The U.S. HVAC market is valued at approximately $30 billion. People cannot survive summer in Phoenix without air conditioning. They cannot survive winter in Chicago without heating. This is not a want. This is survival. And survival does not respond to market cycles. HVAC maintenance contracts pay $150 to $300 per household per year for biannual tune-ups. Stack 500 contracts and the maintenance revenue alone hits $75,000 to $150,000 annually before a single emergency repair call comes in. That is guaranteed revenue. It shows up every spring and every fall. An HVAC company with 3 trucks and 5 technicians generates $800,000 to $2 million in annual revenue, with owner income of $150,000 to $350,000. Startup cost runs $15,000 to $50,000 for a van, tools, EPA certification, and licensing. Now compare that directly. Put $50,000 into an index fund. At the historical average of 10.7%, you earn $5,950 in year 1. With an HVAC business, that same $50,000 generates $150,000 or more in owner income in year 1. The gap is not a rounding error. It is a 28x difference. And the HVAC income arrives in your checking account every month. The index fund gain exists only on a screen until you sell. Business 11, appliance repair. When the dishwasher breaks, nobody opens their brokerage account to fund the replacement. They call a repair technician. The U.S. appliance repair market is valued at approximately $6.5 billion. A solo technician with a van and diagnostic equipment earns $60,000 to $120,000 annually. A 2-technician operation scales to $200,000 to $350,000 in revenue. Startup cost, $8,000 to $25,000. Here is what nobody tells you about appliance repair. Home warranty companies like American Home Shield and Choice Home Warranty Dispatch work directly to you. They pay technicians $75 to $150 per service call. You do not need to advertise. You do not need to find customers. You do not need a marketing budget. You get on the warranty company's vendor list and the phone rings. That is the equivalent of having a financial advisor who guarantees you a minimum number of dividend-paying stocks every single month. Except this advisor actually delivers. And every home in America has an average of 12 major appliances. Every one of those appliances will eventually break. And during recessions, the homeowner's first instinct shifts from replace to repair. That shift is your entire business model. Business 10, mobile mechanic services. Here is a stock market comparison that should stop you cold. If you invested $10,000 in the S&P 500 in January 2008, by March 2009, you had approximately $5,300. You lost 47% of your money. 47%. If you had taken that same $10,000 and started a mobile mechanic business in January 2008, by March 2009, you were busier than you had ever been. Because during that recession, new car sales dropped 35% in a single year. The average age of vehicles on the road climbed to over 11 years. Older cars break more, and every broken car needs a mechanic. The stock market punished you during that recession. A repair business rewarded you. That is a structural advantage no index fund in history has ever offered. A mobile mechanic operating from a van with a quality tool set starts for $5,000 to $15,000. Monthly revenue of $3,000 to $8,000 is realistic within 6 months. And by 2024, the average vehicle age had hit 12.6 years, the oldest in recorded history. The trend line is going in one direction. Cars are getting older, repairs are increasing, and the person who fixes them gets paid regardless of what the Dow Jones does. Business 9, bookkeeping and accounting services. The global bookkeeping market is valued at $682 billion and projected to reach $986 billion by 2032. Those are not numbers that suggest an industry in trouble. A solo bookkeeper with a QuickBooks certification and a laptop charges $500 to $1,500 per client per month. 7 clients at an average of $750 generates $5,250 per month. $63,000 per year. Startup cost, a laptop, and a certification course under $1,000. The retention rate is extraordinary. 72% of accounting practices reported increased revenue in 2025. Small business owners hate doing their own books. Once you are reliable, once you understand their numbers, once they trust you with their financial data, they do not leave. You are locked in for years. Here is the uncomfortable comparison. A savings account pays 4.5% right now. A certificate of deposit pays 5%. A bookkeeping business with 10 clients at $750 each pays you $90,000 a year from a $1,000 investment. That is a 9,000% return. And every single dollar of it is cash you control, cash you earned, cash that does not fluctuate because a tech company in California missed its quarterly earnings estimate by 3 cents. Business 8, residential and commercial plumbing. A toilet does not check the S&P 500 before it overflows. Pipes do not wait for a bull market before they burst. And when a sewer line backs up into someone's basement at 2 a.m., that homeowner does not comparison shop or check their brokerage balance. They call the first plumber who answers, and they pay whatever that person charges. The U.S. plumbing services market generates approximately $130 billion in annual revenue. Emergency plumbing calls command $200 to $500 per visit, often with a premium for after-hours work. A solo plumber earns $60,000 to $100,000 annually. A plumbing company with a small crew generates $500,000 to $1.5 million in revenue, with owner income of $100,000 to $300,000. Startup cost is licensing, a van, and tools. $10,000 to $40,000. Think about it like this. Warren Buffett's Berkshire Hathaway has compounded at approximately 20% annually over his career. That is considered the greatest investment track record in the history of modern finance. A plumbing company owner generating $200,000 in annual income from a $30,000 startup has a return on invested capital of over 60% in year one alone. Buffett would need decades of compounding at 20% to turn $30,000 into an equivalent annual cash flow. The plumber did it in 12 months with a pipe wrench. Business 7, roofing and exterior repair. When a roof leaks, no amount of stock market gains fixes the water damage spreading through the ceiling. Mold sets in within 48 hours. Insurance companies mandate repairs within strict timelines. And homeowners who might delay a kitchen renovation for 3 years will not delay a roof repair for 3 weeks because the damage compounds daily. The U.S. roofing market is valued at approximately $28 billion. During the 2008 recession, new construction declined, but re-roofing and repair work held steady because buildings do not stop aging. Insurance restoration work, roofing jobs funded by homeowner insurance claims after storms, increased during the downturn because insurance companies still paid claims regardless of the economy. A roofing crew generates $500,000 to $2 million in annual revenue. The owner typically earns a $100,000 to $300,000. And here is the trick that makes roofing almost unfairly profitable compared to any stock. When a hailstorm hits a zip code, every homeowner in the area files an insurance claim simultaneously. One storm equals hundreds of guaranteed jobs in a concentrated geographic area. You do not need to market. You do not need to convince anyone. You just need to show up with a ladder and a business card. The stock market has never once created a guaranteed revenue event in your zip code. The weather does it several times a year. Business 6, commercial property tax consulting. This one genuinely shocked me when I found the data. Every commercial property in the United States is assessed for property taxes by the local government. And in a significant percentage of cases, those assessments are wrong, usually too high. A commercial property tax consultant reviews assessments, identifies overvaluations, files appeals on behalf of the property owner, and takes a contingency fee of 25% to 40% of the tax savings generated. no savings, no fee. The property owner risks nothing, which makes it an extremely easy sell. An experienced consultant handling 50 to 100 appeals per year generates $200,000 to $500,000 in annual fee income. The startup cost is minimal. You need knowledge of property tax assessment methods, access to comparable sales data, and the ability to present appeals to assessment review boards. No inventory, no equipment, no employees required. Your knowledge generates money. Your time investment happens once per appeal. But the savings compound annually because the reduced assessment holds for years. This is what real compounding looks like. Not a line on a chart that goes up and down with the mood of institutional investors. A skill that creates measurable, tangible value and gets paid for it over and over from clients who never leave because you saved them more money than you charged. Business 5, parking lot maintenance and sweeping. Every shopping center, office park, hospital, and commercial property in America needs its parking lot maintained. That means sweeping, striping, pothole repair, and seasonal services like snow removal and salting. A commercial sweeper truck costs $60,000 to $200,000. A line striping machine costs $3,000 to $5,000. Together, they unlock a business that hums while you sleep. A truck running 5 to 6 properties per night at $300 to $800 per sweep generates $1,500 to $4,800 per shift. Multiply across 20 to 25 nights per month, and annual revenue reaches $360,000 to $1.4 million. Property managers sign annual contracts that renew automatically because the property management company does not want to think about parking lot sweeping. They want it done consistently. Once you hold that contract, you're functionally invisible. Nobody knows your name. Nobody congratulates you at parties. But the checks deposit every single month with the reliability of gravity. And here is something nobody tells you about the stock market comparison. Dividend aristocrats, the companies that have raised dividends for 25 or more consecutive years, are considered the gold standard of reliable income. There are only 68 of them in the entire S&P 500. A parking lot sweeping business with 30 annual contracts has a higher income reliability rate than any dividend aristocrat because your contracts are with local businesses you can visit, not with boards of directors who might cut dividends during the next downturn. Business 4, fire protection and sprinkler inspection. Every commercial building, warehouse, hospital, school, and shopping center in the country has a fire sprinkler system. Every one of those systems must be inspected annually, some quarterly, under NFPA codes. Fail the inspection and the building cannot get its occupancy certificate renewed. The fire protection services industry is valued at over $22 billion. A single inspection visit costs $200 to $2,000 depending on building size and system complexity. An operator managing 300 annual contracts at $800 average per visit generates $240,000 a year from inspections alone. The repair work, where margins are even higher because the building owner cannot negotiate when the fire marshal is standing in the lobby, comes on top of that. The regulations create the demand, the certifications limit the supply, and the consequences of not paying are severe enough that customers never leave. Here is the stock market filter that applies to every business from this point forward. No regulation has ever mandated that the stock market go up. But regulations mandate fire inspections, plumbing codes, health inspections, and building maintenance every single year. When your income is backed by law rather than by market sentiment, you're operating on a fundamentally different level of certainty. Business 3, waste management and junk removal. Garbage does not care about your portfolio allocation. It does not check your asset mix before it piles up. The U.S. waste management industry generates approximately $120 billion in annual revenue. And it grew through the 2001 recession, the 2008 recession, and the 2020 recession without blinking. Waste Management, Inc., the largest operator, reported revenue growth in every recessionary year of the last 3 decades. A small junk removal or trash hauling operation starts with a truck and a dump fee account. Total startup, $5,000 to $20,000. A solo operator generates $50,000 to $150,000 annually. A 2-truck operation scales to $250,000 to $500,000. The trick is commercial contracts. A restaurant paying you $200 a month for weekly grease trap and waste pickup renews every single month because the health department mandates it. A construction company paying you $400 per dumpster swap needs you on every job site for the duration of every project. That is legally mandated recurring revenue. Now compare that to stock dividends. The average S&P 500 dividend yield is about 1.3%. On a $100,000 portfolio, that is $300 per year in dividend income. A waste hauling route with 50 commercial contracts at $200 each generates $120,000 per year from a $15,000 startup. The dividend investor needed $100,000 in capital to make $300. The waste hauler needed $15,000 to make $120,000. And the waste hauler's income does not drop 30% when the market corrects. It does not get cut when a company's board decides to preserve cash. It shows up every month because garbage shows up every day. Business 2, medical billing and healthcare support services. The U.S. healthcare industry generates over $4.5 trillion in annual spending. That is not a typo, trillion with a T, and that number grows every single year, regardless of economic conditions. During the 2008 financial crisis, while nearly every industry contracted, healthcare employment actually increased by 428,000 jobs. People do not stop getting sick because the Dow Jones drops 40%. They do not stop having babies. They do not stop needing insulin, blood pressure medication, or chemotherapy. A solo medical billing business generates $40,000 to $80,000 annually, with nothing but a laptop, a certification course, and a phone. A small billing company with 3 staff members generates $200,000 to $500,000. Here is the stock market comparison that should keep you up tonight. The average 401k balance for Americans aged 50 to 59 is approximately $200,000. At a 4% safe withdrawal rate, the number most retirement planners use, that produces $8,000 per year in retirement income. $8,000. After 30 years of saving. A medical billing business that took 3 months to learn and set up generates $40,000 to $80,000 per year, indefinitely. One path requires 3 decades of discipline. The other requires 3 months of effort. And the business generates 5 to 10 times more annual income than the retirement account. The 58 million Americans over age 65 are not going to stop needing healthcare. That number hits 73 million by 2030. Every one of them generates billing, every month, every year, every economic cycle, without exception. And that brings us to business number 1, the one I have been building toward, the one that quietly, consistently, and relentlessly creates more personal wealth than almost anything Wall Street has ever offered to individual investors. And it is so boring that most people will hear the name and immediately scroll to the next video, which is exactly why the people who do it face almost no competition. Business 1, recurring contract property management. Not buying real estate, not flipping houses, not taking on mortgages or construction risk, managing other people's properties, collecting rents, arranging repairs, handling move-ins and move-outs, screening tenants, coordinating maintenance. A property manager charges 8% to 12% of monthly rent per unit managed. The average rent in the United States is approximately $1,950 per month. At 10%, that is $185 per unit per month in management fees. Here is where the compounding happens. 50 units under management at $185 each generates $9,250 per month, $111,000 per year. 100 units, $222,000. 200 units, $444,000. 500 units, over $1.1 million per year. The startup cost is a real estate license, property management software, and liability insurance. Total, $5,000 to $15,000. And here is the part that makes this the number 1 business on this entire list. You do not need to own a single property, not one. You use other people's assets to generate your income. The landlord takes the risk of ownership, the maintenance costs, the vacancy risk, the mortgage payments, the property tax bills. You collect a percentage of the revenue for solving problems they do not want to deal with. The landlord carries millions in liability. You carry a phone and a vendor list. Now compare that structure to the stock market. In the stock market, you put up 100% of the capital, absorb 100% of the risk, wait 30 years, and earn 10.7% if you're lucky and disciplined enough to never panic sell. In property management, you put up almost no capital, take almost no ownership risk, and earn recurring management fees from assets worth millions that belong to someone else. The Millionaire Next Door, by Thomas Stanley, found that the majority of self-made millionaires built their wealth not through brilliant investments, but through what he called dull, normal businesses. Property management is the crown jewel of dull normal. Nobody brags about it at cocktail parties. Nobody posts about it on social media. Nobody makes viral content about handling a tenant's broken garbage disposal at 9 p.m. on a Tuesday. But the operators who stick with it, who build portfolios of 200, 300, 500 managed units, generate annual incomes that make most stock portfolios look like rounding errors. And unlike a stock portfolio, the property management income does not crash, because a CEO you have never met made a bad decision about a product you have never used. It grows because you add more doors, one at a time, month after month. Now I want to show you what the difference looks like in 2 real lives. A woman named Claire graduated with a finance degree in 2016. She did everything right by conventional standards. Opened a brokerage account at 23, maxed out her Roth IRA every year, invested exclusively in low-cost index funds. She was disciplined. She never panic sold. She contributed $500 a month every single month for 8 years without missing one. By 2024, her portfolio was worth approximately $72,000, accumulated gains of about $24,000 over 8 years. She felt good about it. Then she met a man named Ray at a neighborhood cookout. Ray was 4 years older. No finance degree, no brokerage account, no Roth IRA. He had started a pest control route in 2018 with $12,000 in savings and a used pickup truck. By 2024, Ray had 3 routes, 2 full-time technicians, and 340 quarterly contracts. His annual revenue was $480,000. His take-home after all expenses, truck payments, chemical costs, insurance, and payroll was $190,000. He had used the cash flow to buy a duplex, which he managed himself, generating another $2,400 a month in rental income. Ray's total annual income from his boring businesses, $218,800. Claire's total investment gains over the same 8 years, $24,000. Ray built more wealth in a single year than Claire's portfolio generated in 8 years of disciplined investing. And Ray's income was growing every single month while Claire's portfolio remained subject to whatever mood the market happened to be in on any given Wednesday. The difference between them was not intelligence. Claire was arguably smarter. The difference was not discipline. Claire was arguably more disciplined. The difference was the vehicle. Claire chose a vehicle she could not control. Ray chose one he could. Let me be honest with you for a moment. I'm not saying the stock market is bad. It is a perfectly fine tool for storing and growing wealth you have already built. Warren Buffett himself has said that a low-cost index fund is the best investment most people can make. And he is right if the only alternative is doing nothing. But as a tool for building wealth from scratch for someone starting with $5,000 or $10,000 or $20,000, the stock market is one of the slowest, least controllable options available to you. And the financial industry has spent 50 years and billions of dollars in marketing convincing you it is the only option because they earn management fees when you invest your money with them. And they earn exactly nothing when you start a pest control route or buy a pressure washer. Keith Cunningham wrote something in The Road Less Stupid that fundamentally changed how I evaluate this question. He said the real skill in business is not finding the right answer, it is asking the right question. And when it comes to building wealth, the right question is not which stock should I buy? The right question is, what asset can I build or control that pays me every single month, regardless of what the broader economy does? Every business on this list answers that question. None of them require you to check a ticker symbol. None of them lose 30% of their value because a CEO made a bad earnings call. And none of them need 30 years of patience and emotional discipline to deliver life-changing returns. Here's the takeaway I want you to sit with tonight. The stock market averages 10.7% per year. That is a fact. But it is an average, not a promise. Some years it returns 30%. Some years it loses 40%. You have no control over which year you get. And the actual return most investors earn is closer to 4% because of behavioral mistakes they will keep making no matter how many books they read about staying the course. The 21 businesses on this list do not average anything. They pay you what you build, they return what you put in, they grow when you show up, and they give you the one thing no stock portfolio ever will, the ability to wake up tomorrow morning and decide exactly how much money you're going to make today. So here's your question. Not which of these 21 businesses is the best. The question is, which one can you start with what you have right now? Which one fits your city, your skills, your savings, and your tolerance for doing work that nobody will congratulate you for? Because that is the one that will beat the stock market. Not on a spreadsheet. In your actual life. Drop the number in the comments. Tell me which one you would actually start. I read every single comment, and the business that gets the most mentions becomes the deep dive in next week's video. Hit that like button. It helps more than you know. Subscribe if you want more content about building real wealth without needing Wall Street's permission. I'm John, and I'll see you in the next one.